Right now, as you're watching this, you're living in a different financial world than you were a few years ago, and almost nobody has told you what actually changed. Trillions of dollars have already moved. 5 trillion in wealth has effectively been reassigned on global balance sheets, repriced, re-anchored, and realigned while most people were busy arguing about elections, pandemics, and social media drama. On the surface, it looks like a blur of separate stories. China launching the digital yuan, building its own SCUFT alternative, cutting back on US Treasuries, locking in commodity deals in yuan, expanding BRICS, and deepening its control over critical supply chains. Underneath, it's one story, China has just triggered the next phase of the largest wealth transfer in history, away from savers trapped in an over-leveraged dollar system, and toward those who position themselves in real assets, new payment rails, and the next power center before the reset became obvious. Most people hear 5 trillion moved while you slept and picture a single giant wire transfer. That's not how it works. The world doesn't change with one transaction. It changes when a series of structural decisions cross a tipping point. A reweighting in a bond index that forces hundreds of billions out of US debt and into Chinese bonds. A commodity contract repriced in yuan that slowly erodes demand for dollar reserves. A wave of capital fleeing an overvalued sector in the West into underpriced infrastructure, metals, and energy linked to China's orbit. Each one looks small in isolation. Together, they add up to a staggering migration of wealth out of paper promises whose value depends on US fiscal discipline and into claims on real resources, real production, and alternative systems where Beijing holds more of the levers. If you track what actually sits on central bank balance sheets, sovereign wealth funds, and the portfolios of the world's largest institutions, you can already see something like 5,000 trillion in relative value shifting away from the old regime and toward the new. The mistake is to think this is China versus America in a comic book sense, as if Beijing alone flipped a switch. What China did was pull the trigger on a machine that was built long before it rose. The architecture of the global financial system, the dollar reserve standard, the central bank cartel, the index complex, the derivatives web was designed in such a way that, once the issue of the reserve currency crossed certain lines of debt, debasement, and weaponization, a massive wealth transfer became mathematically inevitable. China's actions over the last decade didn't create that inevitability. They accelerated its execution and changed who would catch the falling pieces. To see this clearly, you have to stop staring at headlines and start looking at patterns. The pattern goes like this. Stage 1, a dominant power issues the world's most trusted currency, backed by real productivity and discipline. Its bonds are the safest asset on earth. Its money is the lubricant of global trade. Everyone from central banks to corporations hold as a store of value. Stage 2, that power discovers the privilege of the printing press. It realizes it can fund wars, welfare, and political promises not just with taxes, but with debt and new units of its own currency. As long as foreigners keep buying its bonds and using its money, it can live beyond its means. The world plays along because it still remembers Stage 1. Stage 3, debt and deficits explode. The domestic economy financializes, real production is offshored, asset prices soar. The currency is still reserve, but quietly, its real purchasing power starts to erode. The issuer begins using its financial infrastructure as a geopolitical weapon. Sanctions, asset seizures, payment system blacklists. Major creditors and rivals notice. They don't panic, they plan. Stage 4. The smartest players begin converting their claims on the old system into claims on whatever will matter after the reset: gold, commodities, critical metals, strategic infrastructure, and crucially alternative currencies and payment systems. They don't scream about it. They don't announce a dollar collapse date. They just stop showing up to every auction, reduce their incremental demand for the old paper, and quietly deepen trade, lending, and settlement in forms that don't run through the old empire's pipes. This is the stage where the real wealth transfer happens, not when CNN announces it, but when the balance sheets quietly drift to a new equilibrium. China has been in Stage 4 for years. The 5 trillion you're hearing in this title isn't a prophecy, It's a rough, conservative description of what's already happened across a series of moves: reductions in US Treasury holdings, increases in gold and commodity exposure across China and its partners, the repricing of Western assets as rates rise to cope with the very inflation and instability the system itself created, and the latent value embedded in new rails being built out of sight of most Western savers. Consider just one lever: reserves. For decades, the default for any central bank was simple. Hold dollars and hold them mostly in US Treasuries. That's what Stage 1 and 2 of the dollar system built. Then came the Iraq sanctions, the Iran sanctions, the Russia sanctions, the freezing of central bank reserves. A subtle but existential message went out. Your savings in our system are conditionally yours. They can be turned off. China already read that message in the early 2000s. The rest of the non-aligned world got it loud and clear in 2014 and 2022. Since then, the composition of reserves has been shifting, a little less treasuries, a little more gold, a little more yuan swaps, a little more local currency lending through China-backed institutions. By itself, a 2%, 3%, or 5% shift in global reserve allocation doesn't sound like much, But when you apply those percentages to a 1 to the 15 trillion pool of official reserves and sovereign wealth, you're already talking about hundreds of billions sliding quietly away from U.S. paper and toward alternative anchors. Multiply that across multiple years, add in private capital that follows the same signals, and you're in trillion-dollar territory. Now layer on the bond market. As China and other big holders slowed their appetite for treasuries, someone had to fill the gap. Either domestic investors at higher yields, or the Federal Reserve with new money. In both cases, the adjustment comes with a cost higher interest rates that crush the valuations of existing bonds and long-duration assets. Every uptick in yield is a down tick in the market value of the tens of trillions in bonds already outstanding. That loss doesn't show up on a screen as China took your money. It shows up as your bond fund bleeding value, your mortgage market seizing up, your government's interest bill exploding, your equity valuations resetting lower. This is part of the $5 trillion. The transfer from anyone who thought safe meant fixed income in a debasing system to those who either sold early, shortened duration, or shifted into assets that benefit from higher nominal pricing and tighter supply. Then there is the commodity axis, where China has been playing a far more sophisticated game than the West has acknowledged. While Western governments fantasized about paper wealth in tech stocks and real estate, China spent 2 decades securing long-term access to oil, gas, copper, lithium, nickel, rare earths, and food. It didn't always pay in dollars. Increasingly, deals are denominated in yuan or involve barter, like structures tied to infrastructure and influence. When you lock in the future flow of physical stuff the world needs to function, you are claiming a stream of real value that will, in crisis, be worth far more than the notional financial assets whose price is based on low inflation and global stability. Every time a Western institution sells off a commodity producer at a discount because of some ESG edict or short-term panic, and a Chinese-linked entity quietly steps in, a slice of future cash flow moves with it. Price that future cash flow over a decade, discount it, and you're looking at another slab of the 5 trillion, wealth moving from Western shareholders and savers to entities aligned with Beijing's long-term strategy. The digital yuan and alternative payment systems are another, more subtle piece. You don't need every country to stop using dollars to feel a shift. You just need enough volume in critical trade energy, metals, food to start clearing outside the old rails. When a Chinese energy deal with a Gulf state settles in yuan, or when a Belt and Road loan is repaid in local currency via a Chinese digital ledger, that's one less marginal use of dollars, one more proof point that you can live without the greenback as your sole unit of account. Over time, as more actors gain the option to route around SCUFT, key HEPAS, and New York-based clearing, the premium the U.S. has long enjoyed on its debt, the exorbitant privilege of printing the world's reserve, begins to erode at the margin. Again, that erosion doesn't scream at you, it drips. A few basis points higher here, a slightly weaker bid there. But compounded over a debt stock of 30+ trillion, and through a global system where U.S. paper used to be the unquestioned king, those drips are a torrent. The wealth transfer hides in the spread. Now tie this to history. Because this exact dynamic, a rising power triggering, not creating, a wealth transfer baked into an old regime, has played out before. In the late 1800s, as Britain's relative industrial strength waned and America soared, capital flows followed. British investors, seeking higher returns than they could get at home, poured money into U.S. railroads, mining, utilities, and land. They still counted their savings in pounds. Their bond certificates still referenced London. But the real productive base and the embedded option on the future was moving westward. When the pound eventually yielded to the dollar as linchpin of the system, the transfer was complete. Claims on British paper had functionally become subordinate to claims on American reality. China is not America circa 1900. Its system is more controlled, its politics more opaque, its demographics more challenging. But in one essential respect, the rhyme is clear: it is using the existing architecture to build its own, and in the process it is attracting, commanding, or absorbing streams of real value that used to be presumptively under U.S. influence. The $5 trillion isn't all in Beijing's vaults. It's in owned stakes, secured flows, repriced obligations, and lost optionality on the Western side. And where are you in all of this? If you hold most of your wealth in cash that pays less than inflation. Bonds whose real yield turned negative for years while central banks played God. Index funds overweight the very markets and sectors most exposed to the old regime. Then you are structurally on the side of those losing the game, even if your account statements haven't admitted it yet. You're long the status quo at the exact moment the status quo is being redesigned. If, on the other hand, you have even begun to think like a stage 4 actor, not in terms of China good, America bad, but in terms of atoms over promises, then you at least have a shot at being on the right side of the transfer. That doesn't mean buying into every China narrative. It means understanding why a major creditor would choose to hold more gold and commodities over time instead of only US debt. Build systems that can settle trade outside the dollar, take the other side of Western divestment from dirty but essential industries, deepen control over choke points in energy, logistics, and manufacturing. All of those moves are different ways of answering one question. When the next monetary reset comes, Kreen, what do we want to be holding? 500 trillion has already been answered that way in practice. You can ignore this. You can tell yourself it's too abstract. Kreen, that geopolitics is for politicians, that markets will always come back, that a 63-40 portfolio and blind faith in the Fed will carry you through like it did your parents. Plenty of people in Rome, in Habsburg Spain, in Lady Imperial Britain, in pre-Nixon America told themselves the same story. It worked until it didn't. When the break came, the pattern was merciless savers in the old unit were sacrificed, holders of real claims in the new structure survived. The biggest wealth transfer in history is not a single event, Kreen. It is a process. China didn't start it. But China just pushed it into a new gear. And while you were sleeping distracted, divided, lulled by nominal portfolio values and official narratives, trillions in real, structural advantage shifted. This is not a call to worship Beijing or to abandon where you live, Kreen. It's a call to stop thinking like a spectator and start thinking like a participant in a machine that does not care how you feel about it. It cares what you hold when the music slows down.